Welcome to the Remarkable Retail Podcast, Season 11, our last guest episode for 2025. I'm Michael LeBlanc.
And I'm Steve Dennis.
Our guest on this episode is Mark Zandi, Chief Economist at Moody's Analytics and host of the Inside Economics podcast. Mark is a globally trusted voice whose forecasts shape policy, guide markets, and consistently anticipates major economic shifts with remarkable accuracy and clarity. And importantly, unlike me, who plays an economist, is an actual PhD economist. In the news, some early Black Friday performance sentiment, dollar store category, and moves ahead. Ulta progress at Macy's is gaining purchase, and we'll be back with what we each found particularly remarkable this week and a look around the corner. You know, Steve, fun factoid, I asked ChatGPT and Gemini to figure out how many guests we've had. I was just giving them a bit of a test. They both failed the test, by the way, the first time around. Apologized profusely after, which just freaks me out. Mark, I think, is our 41st or 43rd guest of the year. Pretty incredible when you think about it. We've talked to such amazing
of the year,
people.
Yeah.
You know, like the calendar year, not the season. I just want to take the opportunity to thank everyone who joined us and shared the gift of their time and the treasure of their insights for 2025. And of course, that brings us, our minds start to turn to 2026. Tell the people how we're going to jumpstart the season next year and just at before and then at the Big Apple.
Well, we are getting ready for the new year. And some of that, as you alluded to, centers around retail's big show, the NRF Big Show. And we'll be getting together with some of our fellow top retail voices. And of course, lots of friends and colleagues, and seeing all the presentations, probably not all the presentations, but a number of the presentations that will be on stage. So if you're going to be there, try to track us down. We'll actually share a little bit of information about where we're going to be specifically, which is related to the next thing I was going to say, which is we will have a dedicated podcast studio on the floor of the show, courtesy of Narvar. Who is Narvar? What is Narvar? Well, Narvar is the #1 platform for intelligent personalization beyond buy, helping over 1,500 of the world's leading brands transform their post-purchase experience into a strategic growth engine. Powered by Iris, Narvar delivers data-driven insights that build trust, streamline operations, and drive loyalty across every touch point. So we'll be sharing a bit more information about some of the specifics of what we're going to be doing. But yes, we will be interviewing quite a few people with any luck.
Yeah.
We had a pretty good run of getting people to say yes this year. So I'm pretty confident we'll get some yeses. But anyway, look for more about our plans in our final episodes of the season, as well as on LinkedIn.
Speaking of great content, I'm a big fan of Substack. I follow lots of super interesting people there. And you are about to join the likes of Dolly Parton, who joined in November, started a page. Tell the people about what you're up to.
Yeah, well, last week I launched my new Substack newsletter. It's called Pardon the Disruption. So you can go find that pretty easily, either by searching for my name or for searching for Pardon the Disruption. And the intent, we'll see how I do. The intent is for it to both replace my longstanding newsletter, which was on Constant Contact, but I'm taking a pretty different content approach. So it's meant to be a weekly Substack. I'll be varying the approach a little bit. So those of you who have seen the first one will know it's a little bit of a long form piece with just a couple of other things, but I will also be mixing up important news you want to look at, perspectives on what's going on. So pretty specific to retail, but also just more broadly dealing with transformation and disruption.
All right, fantastic. Well, everybody listening who can hear the sound of my voice, smash that subscribe button. All right, well, let's get to it. We know holiday is a marathon, not a sprint. And as we enter the valley of death, so to speak, the post-Black Friday event, what do you say, or what are you seeing about how the overall retail holiday event is shaping up for retailers?
Well, to a certain degree, if people have followed me for a while, they may know that I often refer to a lot of the news coverage as the hypey holidays, because it gets a ton of coverage. And I would say two things are characteristic about it. One is there's all sorts of data, and oftentimes it doesn't completely line up. So it's a little bit hard to make sense. Actually, maybe there's three things. There's always three things. I should just say three things.
Always three things.
Too.
Always.
The second is that there's a lot of time still to go. I will talk about some numbers in just a second, but we still have lots of good shopping days ahead. Typically the two biggest days of the year are the two Saturdays before Christmas. Depends a little bit on how the holiday falls, but because Christmas is a Thursday, we've got two big weekends leading up to it, and they have not happened yet. So lots to go. And, I think in general, we get lots of information on sales, but we don't get any information on profits. So just because your sales are good doesn't mean your profits are going to be good. But anyway, I would say the overall perspective so far, particularly around the 5-day Black Friday, Cyber Monday period, is that it, on average, was pretty good. A little bit better than expected, I would say, would be the consensus. We've got a little bit more granular data specific to e-commerce. So Adobe had Cyber Monday up 7.1%. The 5 days from Black Friday or the 4 days from Friday to Cyber Monday up almost 8%. So that's definitely above trend. And their season to date data, which is really November 1st through December 1st, up 7.2%. So given what we've talked about with e-commerce trends of late, given what we've talked about retail trends of late, that would be a little bit better than average. One little interesting factoid is buy online, pay later, BNPL, up over 9%, so gaining a bit of share there. But to your point, we are now in what is usually a pretty slow period until things really start to ramp up again in the back half. So we shall see. As I talked about last week, the early results are not necessarily indicative of how the whole season will come in. Last thing I'll just say quickly about some data, which really lines up with what we talked about last week. AI traffic, according to Salesforce, is up 670%. I think last week we quoted about 6 times, so that's closer to 7 times. So maybe we're getting a little bit of momentum as we go into the end of the holiday season. And Salesforce says that 20% of all e-commerce related traffic was influenced by AI. So that's pretty significant, but definitely not the majority. If I had to guess right now, and we'll talk a little bit about what Macy's had to say about the holiday, I would say things look to be trending towards the higher side of people's estimates, but still plenty of good shopping ahead.
On this side of the border, I talked to Moneris, who handles 30% of all transactions everywhere, not just online, but in-store as well. They measure just the Friday, the Black Friday, and they measure a 4% decrease in just the day. And it's also comp store decrease because they net out, maybe they picked up a new customers. All right, last week, let's dive into some last week's quarterly earnings. We had news from a whole host and a whole spectrum of retail formats. Let's talk about the dollar stores first.
Well, I'll be pretty quick about this and really try to focus on the so what, but I think you like to call it the stampede to value as opposed to flight to value. I mean, pretty much any of the major players that are running a decent business continue to perform well. So the two big players here in the U.S. anyway, Dollar General and Dollar Tree, both reported really solid results. From the top line, though a little bit weaker than they've been historically, and the profits were kind of on the weaker side. So again, this whole issue of you can drive the top line, but not necessarily seeing so much flow to the bottom line. Tariffs are probably part of that story. The more dollar store-oriented player that I really wanted to call out, which is one of the smaller players, because when you look at Dollar General and Dollar Tree, they have thousands and thousands of stores. They continue to open hundreds of stores. Dollar General in particular is remodeling something like 1,500 stores in the next year. So that's kind of a crazy scale. But what I think was most remarkable was Five Below, which is a U.S.-only player, I believe, so far. They're up, though, to over 1,900 stores. Their comps were up 14.3%. So that is definitely one of the highest numbers we've seen from any major retailer this past quarter. They were actually losing money, and I think a lot of this has to do with how aggressively they're expanding, but they managed to make a profit, and they continue to open quite a few stores. So I think that's really a retailer to I think we've talked about them once or twice along the way here, but they're getting to be quite a large player with a lot of growth. And obviously they are gaining share with that kind of comp store performance.
A quick question for you on the dollar store format. Do you perceive any tailwind, let's call it a tailwind, from the end of de minimis? So a bit of a knock on the Temus and Sheins. There may be some opportunity there that they're seeing in their numbers and sales already from a less volume coming from those China direct models.
Probably a certain degree. I mean, the merchandise mix in the dollar stores, I think, there's not a ton of overlap with what people would typically buy from Temu and Shein, but on some stuff, given the price points, I think that could definitely be a factor. I think the broader issue is really the trading down that's going on from higher price retailers. I mean, we see that with Walmart, we see that with off-price guys. So I think that's the major driver. But the de minimis part. But then you net that against they've got a fair amount of product that comes from China. Where the tariffs are presumably pretty high. In a different vein, got some results from Ulta and another strong quarter. The beauty business in general seems to be doing really well, unless you're at a department store, which we'll come back to in a second. But their comps, 6.3%, sales up almost 13% because they continue to open stores. They're now expanding into some international markets. But again, this idea of profitless prosperity, which we talked about last week, their net income was down. So I imagine some of this is tariffs. Some of this may just be discounting. There wasn't a lot of color around that. One thing we should mention, though, which will be a challenge that they'll be up against next year, is they are exiting Target stores. So that's a good chunk of their volume. So that may help their comps because they'll be losing some competing stores and trade areas. Right. So that'll be a little difficult one to completely understand.
Let's talk about Macy's. You've been historically a very good barometer of these kind of turnarounds, pointing out to everyone, hey, let's not get ahead of ourselves. A few good numbers don't mean a turnaround. But you're starting to see some traction or purchase, I would say, in the Macy's turnaround. Yeah,
to me it's still, and I know people think, I get lots of notes about people saying I'm way too negative on Macy's. And I would say this was a pretty mixed picture. There's definitely evidence of some traction there. They just reported the best quarter they've had in about 3 years. Bloomingdale's in particular did very well, over 8% comp. But a couple of concerning things. One is their comps just continued to be below their competition. Now, you could look at their competition as the off-price guys that have like twice the comp store sales, or you could even look at it against Dillard's, which reported a better quarter. Dillard's doesn't get nearly enough attention because they're smaller in terms of number of stores, but they're actually much more profitable. And again, in the spirit of this profitless prosperity discussion, yes, they move the top line, but they're still not making any money. Really, their profits are coming from the credit card business, which you and I have some familiarity with. The other thing is that they guided lower for this quarter, basically saying that they expected comp store sales to be more or less flat. And I assume that has to do because when they had their earnings call, they were already 5 weeks into this season, this quarter. That suggests they're not doing especially well, that they're off the trend that they saw last quarter for whatever reason. So, to be fair, several more quarters are going to have to be in the books before we can really get a good read. But I would say it's a pretty mixed picture, but some improvement for sure.
In prior episodes, we've talked about this Supreme Court challenge to the tariffs. That's already been, I guess, heard by the U.S. Supreme Court, and the decision is pending late this year, maybe early next year. I don't know. I was fascinated to see Costco launching a lawsuit to kind of get ahead of things. I'm not sure. I'm not sure what the purpose is. And I also see they just signed up on their board a very, very senior Biden administration commerce person. So what's going on with Costco? What are they doing?
Well, several companies have filed lawsuits to try to get their tariffs back. So there's going to be whatever legal ruling there is. And then I guess there's a civil possibility of saying Basically, you took this money from us without justification. So Costco has been one of the few players, big players, to really get out in front of this. So, or not out in front of this, but to make a big deal about this. So yes, they're suing the government to get the profits back, saying that it was the jurisdiction or the power of the presidency was exceeded. I don't know what all the legal ramifications of this are going to be if the Supreme Court rules that the tariffs were unconstitutional and need to be refunded. Presumably Costco would get that money back. So I don't know if they're like, oh, this is a backup plan to how the Supreme Court case may go. But I think what's interesting about it, really, I mean, it's a reminder that perhaps this tariff situation isn't well settled and something could happen in the months ahead that would really change the equation. But I think it's also noteworthy in that lots of companies, anybody who's following the politics of the United States would know, many companies are basically kissing the Trump ring, donating to his ballroom, showing up at these events and kissing his butt, basically.
Or just staying quiet, right?
Or just laying low. Costco really pushing back is noteworthy, I guess, in terms of a well-known company really saying, hey, we had enough, give us our money back.
Yeah. I don't typically think of Costco as a big political player. They kind of keep to themselves and do their great work. But so I thought it was super interesting. And particularly signing up a former Biden person now in conjunction with this seems like they're making a point, but I don't know.
You make a good point because Costco is one of those companies. I mean, you rarely see Costco executives speak at conferences. You rarely see Costco executives on CNBC, Blooming. I mean, they basically do their business and aren't big self-promoters. So that in and of itself is pretty noteworthy.
And that's a wrap for the news. Now let's get to our fascinating interview with Mark from Moody's. Fantastic interview. So without further ado, and there's been much ado, let's have a listen. Mark, welcome to the Remarkable Retail Podcast. How are you doing this afternoon?
I am doing okay. It's just after Thanksgiving. I had a great holiday, and it's good to be back on podcasts like this. So good to be with you.
Well, fellow podcaster and such an impressive background and CV off mic. Steve was listening to you back in the time tunnel and saw you opining on things to come. And it's so great to have you on the podcast. Where are we finding you today?
Well, I'm in the suburbs of Philadelphia. I grew up here. My kids joke that I've been sheltering in place all my life, so I haven't really moved very far. Yeah. I travel a lot.
Yeah, I'd imagine. And I think you got your degree from Wharton. Is that right?
Oh, yeah. I'm Penn through and through. University of Pennsylvania undergrad, went to Wharton School undergrad, and then went to the graduate program in economics and got my PhD at Penn. So I'm Philadelphia.
Well, Mark, thanks again for joining us on the pod. And why don't you, if you could, share a little bit about what you do for a living?
The chief economist at Moody's. I have a couple hundred folks around the world, economists, data scientists, statisticians that work for me. We produce forecasts of economic, demographic, financial variables that are used widely by financial institutions around the globe, non-financial corps, government, a range of applications, everything from capital planning, stress testing, climate risk analysis to budgeting, what is going to be the impact of a change in the tax code on investment spending and tax revenue. So, lots of different things, but it all revolves around economic forecasting.
Right. Now, in that team that you have, is there focus by country or by sector or by industry, or is it a little bit of both?
All of the above. Cover all the countries around the world, cover subnational. So it depends on the country. But here in the U.S., we can go down to the block group level. So if you want to know what's going on, next door, you can help you with that. And then cross industry. So we're some industries more than others, but industry as well. So it's pretty broad based.
All right. Well, let's start zoning in on our industry, talking about retail, and let's start with talking about the state of consumers. Now, how would you describe today's consumer, at least in America? We've heard things like truly resilient. I often joke they're like the Timex watch. They take a beating and keep on ticking and keep on shopping. But talk about your perspective. As we know, there's not one customer. There's many different segments. So how do you think of it?
Yeah, it's tough to find the kind of the median consumer, right? I mean, because the distribution of consumers is so different. The folks at the top end of the income and wealth distribution are doing quite well. Their financial situation is very good. You could argue about as good as it's ever been. So they're out spending. Folks that are in the kind of the middle part of the distribution, it's okay. You know, they're hanging tough, doing their thing, but there's they're under a lot of financial pressure given the affordability crisis that is now an issue again. And then, of course, if folks in the bottom part of the income and wealth distribution, it's a real struggle. I don't sense that they're pulling back on spending, but they certainly are struggling to hang on and continue to spend. They're borrowing, have been borrowing to kind of finance the spending. So it's more of a struggle. So if you add it all up across all consumers, it's fine. It's okay. Real consumer spending all in across all things that we buy is growing 2%-ish, maybe a tad above. And that's kind of right down the strike zone. So that's good. It's just that there's these big differences across the distribution of consumers. So singling out the kind of the typical consumer, that's pretty tough in today's retail world, I think.
So there's this, actually, even before I ask this question, I just want to acknowledge that it's nice to have a real economist on here. One of the things that Michael and I have discovered in the 5 or so years we've been doing this podcast is we've ended up talking much more about macroeconomics than we probably expected to. And while I technically do have an economics degree, I haven't really put it to much use other than really going beyond my knowledge to opine on things. So it's great to actually have somebody who does this for a living and does it so well. But I think part of what you're pointing to is the so-called K-shaped economy. I often talk about this bifurcation that we've been seeing in retail, where there's a lot of strength at either end of the kind of value spectrum up to the luxury segments, and then not so great everywhere in between. Can you just talk a little bit about how we got here? Because I think some of this is not terribly new, right? And what do you really see as we look ahead? I guess that's really the question. Like, what are the implications if this pattern of K-shaped continues?
Yeah, Steve, that's a lot to unpack. I mean, it's this skewing of the income and wealth distribution, which is being characterized as the K-shaped economy, has been long in the making. It really began, all the way back in the 1980s. Felt like the skewing had come to an end towards the end of the last decade before the pandemic, but since the pandemic, the skewing has become even more pronounced. And just to give you a statistic to kind of strike that point home, the folks in the top 10% of the income distribution, so these are people who make over $275K a year. And of course, 275 doesn't go as far in New York as it goes in Des Moines, but just nationwide, 275K, they account for almost half the outlays, personal outlays. Now, personal outlays is a little bit bigger concept than consumer spending, but it includes charitable giving and other stuff. But that gives you a sense of magnitude. So this K-shaped economy has been forming for the last 3, maybe even 4 decades, and it's just gotten to a point where it's just become more obvious, and it's really intensified, in the post-pandemic period. A boatload of reasons, a lot of debate as to what's going on, just a range of factors, but most recently, it's the surge in wealth, the run-up in stock prices and housing values since the pandemic. And of course, it's the folks in the top part of the distribution of income and wealth that own most of the stocks and a lot of the housing.
Sure.
And so if the values of those assets are up, they benefit enormously. And that's contributed a lot to the skewing of the income and wealth distribution in the last 5-6 years and led to now what we're calling the K-shaped economy.
And do you, as I think we shared with you and your team, we've got a mostly North American audience, but we do have plenty of folks that listen to us in Europe and Australia and around the world. Is this K-shaped economy particularly pronounced in the U.S., or do you see it to somewhat similar degrees in other countries?
It is particularly pronounced in the U.S., and that goes to government policy. If you go to Europe, for example, or most developed economies outside of the U.S., Canada or Australia or Japan, much more progressive tax code. So folks that have high income and a lot of wealth are just taxed at a higher rate, and that is used to provide income and other forms of financial support to lower and middle income households. That happens here in the U.S. too, just not nearly to the same degree. The other big difference is ownership. Stock ownership in the U.S. is very high. About 2/3 of the population own stock. Of course, it's really the top third that own most of the stock, but the ownership is much broader here. Home ownership is high, but stock ownership is exceptionally high compared to the rest of the world. The only country where that might be more similar to us is the UK, but other than that, yeah. So this run up in stock values in the last couple 3 years, the surge in artificial intelligence stocks has really made a big difference, and that's very unique to the U.S.
And do you think, I guess, a couple related questions? There's a concept that I've been talking about for a while, though I hardly originated it, is just pointing to this great concentration that's going on. So you alluded to the degree of the stock market gains that are driven by just a few of these big cap companies. But, and I don't know if you've looked at this in particular, but one of the things we've observed in retail is if you look at the incremental growth in retail, a very high percentage, something like 60% of the incremental growth is coming from 7 or 8 retailers. I guess I just wonder if from an economic standpoint, it would seem that just raises the risk quite a lot of perhaps, and we're not an investment show. We're not trying to predict whether there's an AI bubble or what have you, but it does seem that the broader economy and retail in particular could be a lot more vulnerable to a downturn and just kind of an escalation or cascade, I guess, of downside risk. Any general thoughts on that great concentration idea?
It's a great point. But before I weigh in on that, can you tell me who the 7-8 retailers are? I didn't know that about retailing. That's interesting.
Yeah, over 50% comes from Amazon, Walmart, and Costco.
Right.
And then I think you get to the 7 or 8 by adding TJ Maxx, Shein, Temu, and Target, and Home Depot. Some of these really prominent retailers, and that's been true, I think, for the last several years. So it's way out of proportion with collectively they represent a good share of retail, but it's really out of proportion in the last couple of years.
Yeah, you make a really good point about concentration risk. I mean, the most obvious, and I didn't know that about retailing, but that's very interesting. But you can certainly see it in the equity market. I mean, the so-called Magnificent Seven, just broaden that out to the top 10 tech AI stocks. They're running the show. They're driving the train here in terms of the run up in equity prices. But you can feel it in lots of different industries across the economy that it has become more concentrated. And, it does manifest in different ways, one of which is higher profit margins and higher profitability. I mean, if you look at overall corporate profitability economy-wide, it's pretty close to a record high. And it really has gotten exacerbated in the pandemic because the pandemic and all the supply chain issues and other disruptions allowed big increases in prices. That goes back to the affordability issues. And you would, if you're in a competitive, environment with lots of competitors, those margins will come back in. Pricing would be, much more aggressive. You might even see some price declines, but we haven't seen that. The businesses have been able to hold on to those margins, and that goes to the concentration. And it does pose risk. If you go look at the consumer, and most of the growth is coming from spending by the folks in the top part of the distribution. If something goes wrong for those folks, let's say the stock market heads south as opposed to marching ever higher, farther north, that could become a real problem for those folks pretty quickly. Not that they've got plenty of resources, so I don't know that they would run for the bunker, but they would become much more cautious. And if they're cautious, and given that the low and middle income households are struggling, that's the fodder for a bigger macroeconomic problem, even potentially a recession. So I do think this so-called concentration risk is a real deal, is really happening, and has all kinds of implications in terms of pricing, margins, profitability, and ultimately the sustainability of the economic expansion.
We'll be right back right after these messages. Promotional support for the show comes from Find Mine. Top brands like Ann Taylor, Lululemon, and Anita Bing trust Find Mine to increase return on advertising spend and customer lifetime value through on-trend programmatic ads and landing pages, as well as highly personalized, complete-the-look, matching sets and lookbooks. Whether using AI imagery or your existing product imagery, Find Mine delivers 50% higher ROAS and more loyal, full-price customers. Book a time to meet them at NRF at findmine.com/NRF. Promotional support for the Remarkable Retail podcast is provided by Crave Retail. What's retail's biggest blind spot? The fitting room. A shopper wants to buy, but can't get the help they need. That's why global brands partner with Crave Retail, the market leader in smart fitting rooms. Crave connects that moment to your business, giving shoppers a voice, associates real-time alerts, and teams the data to buy smarter. The result? Higher conversion, better decisions, a seamless experience. Learn how fast you can elevate your fitting rooms at craveretail.com. Mark, let's shift gears a little bit, talk about a related topic in a broad sense. Let's talk about tariffs. It's hard not to have any discussion connected to the retail industry without talking about tariffs, I suppose, in many, many industries.
Sure.
It would seem that the Trump tariff policy has not had as negative an impact as many were worried about. So first of all, would you agree with that assessment? And then would you say that it is a kind of a when and not if there's a negative impact, or what's your assessment for looking ahead to 26 in the context of tariffs and prices and margins and the economy?
When this all began at the start of the year, you listen to economists like me, we said tariffs would slow growth and raise inflation. And that's definitely happening. I mean, in terms of slowing growth, you can see it vividly in the job market. Job growth since Liberation Day, so-called Liberation Day back in April, has effectively come to a standstill. I mean, there's really very little job growth. The only sector of the economy that's adding is healthcare, which is, I'll take it because it's a big sector. You have healthcare jobs in every community across the country. But that's it. Every other industry, particularly the ones that are dependent on trade, they're getting crushed. I mean, manufacturing is in recession. Agriculture is in recession. Mm-hmm. Trade and transportation distribution is in recession. So that's happening, and I think that's clearly in the data. And actually, the weakening in the job market more pronounced than I would have thought. Although there might be other things going on like AI, we can talk about that. In terms of inflation, that also is happening. We are seeing prices for imported products subject to tariffs rise, and you can see it in the inflation statistics. The consumer price inflation at the start of the year was 2.5%. Now it's 3%, and it continues to march higher. And that's pretty close to script. It may be a little slower the pass through to consumers, but I chalk that up to the ups and downs and all arounds in the tariffs. The president has, been moving them around a lot, and retailers just don't know where they're going to land.
There's also a school of thought in our industry that a lot of retailers brought in epic amounts of inventory ahead of tariffs, so that maybe the consumer's not feeling the impact, or maybe the vendors are absorbing some of that margin hit. Maybe the retailers are. Like, any thoughts on that? Does that resonate with you?
Yeah, that does. The forward buying, but to get ahead of the tariffs, it was massive, and the tariff impacts won't show up until you work down all that inventory. But I think it's more about the uncertainty. And you take Costco now that the lawsuit against the administration about they want a refund if the Supreme Court finds that the reciprocal tariffs that were implemented under the IEEPA, under national emergency grounds, whether that's struck down by the court, Costco and other retailers want their money back, the tariffs back. Yeah. But that just goes to they have not passed through because they just don't know, where that court case is going to land, what it means, and where all the tariffs are going to be. And as a result, they're slow to pass through. But they will, once things settle down. And if the tariffs remain in place, then I firmly believe we're going to see continued pass-through. It will probably end up in the same place as I expected at the start of the year. It's just going to take longer to get there.
So as we think about affordability more broadly, and again, this is obviously a big topic of conversation in the U.S. in particular, but when I think about issues like housing costs, labor costs, I think we see that in quite a few countries. If you're running a retail business, what should leaders be thinking about as we go forward on whether there might be any relief there, or whether we're kind of in a relatively permanent cycle of escalating housing costs and just challenges in the labor market.
There's a lot of challenges here. It's not. There's no easy solution. There's no smoking gun policy step I could take to address the high cost of living. Whether that be housing, healthcare, food, on and on and on. Each one of those products, each one of those goods and services, has its own story. It's very idiosyncratic. You got to work through those issues. I know housing quite well. I mean, the number one problem there is zoning and permitting. Good luck with that. I mean, that's set at the local level. The federal government has very little ability to influence that. It's certainly not anytime soon. So I think, these affordability issues are going to be with us for some time. Now, one thing we could do, and I'm not saying this is going to happen, but you could get rid of the tariffs, and you could have a rational immigration policy so that we have, a steady flow of immigrants with the right skills that we need. And goodness knows we need immigrants with all skills, low, middle, high skilled. We need all of the above. If we did that, then that would take some broader pressure off inflation and prices, across lots of industries, and that would help pretty quickly. But the affordability problem is a supply problem, and the supply problem is pretty pernicious and difficult to address. And again, there's no broad-based thing one could do here. It's a lot of blocking and tackling and hard work. And by the way, persistence. I mean, you put policies in place, like, for example, tax subsidies for investing in producing clean energy, wind and solar. For that to come to fruition, you got to stick with it, but we're not. And so we're giving that up. And that goes to the cost of electricity, which is, become the poster child for this affordability problem.
Can I just go back to talking about the job market for a second and get your perspective on parsing out the impact of AI? So there's lots going on in the job market. You mentioned immigration or lack thereof or whatever, but let's talk about this. I mean, if you looked at a very, very high level, it would seem that there's a correlation that could be spurious between a lot of companies adopting AI and less hiring, less jobs. Do you guys factor that in as a threat to the job market or a net positive for productivity? How do you think about that?
Yeah, indeed, it's a tough one, and I think the fingerprints of AI are now clearly on the labor market. You can see it, particularly with regard to hiring, and particularly hiring of young people. If you look at what's going on with the folks in their 20s, particularly in their early 20s coming out of school, they're just having a tough time finding a job. Hiring rates are recession-like lows, and unemployment has taken off. It's over 9% now for the 20, 24-year-olds, and up 3 percentage points in just the last couple of years. And that's despite weak labor force. A lot of those kids are just discouraged, not even looking, and therefore not even counted. So that gives you a sense of it. And there's been some good studies, kind of connecting the dots between that and AI. A good study done by a group of Stanford professors that used data from the payroll processing firm ADP. So they did a pretty good job of connecting the dots. But I think these are early days, and I do think AI is going to have much more of an impact on the labor market here going forward. And one of the biggest threats to the economy is if the AI comes on so fast and the productivity gains are so significant that in a world where we already are not experiencing any job growth, what does that mean? And, does that mean we're going to lose jobs? On net, is the economy actually going to lose jobs? And if we lose jobs, how does the economy hang together? I mean, you lose jobs and consumers pull back, retailing suffers, retailers and everyone else pulls back on hiring and starts laying off, and that's a recession. So that is clearly something we need to be concerned about. Now, obviously, a lot of it depends on how fast those productivity gains are realized. Maybe, past technologies, it took a while for the technology to diffuse, like the internet, so the economy could adjust and you didn't see those kind of job losses. But this could be different. And what is different is the state of the job market. It is already very fragile, weak. We're not creating any jobs. So if we see any real weakness due to AI and the productivity gains, we got a problem. So I view that as a very significant threat to the economy, to retailers, and everyone else as we move forward into next year.
So, do you just kind of sticking on the impact of AI? I don't know if you follow Scott Galloway at all. One of the things that he has said is that the U.S. economy is one big bet on AI, And I think in that case, he's talking more about the stock market and as well as just the AI investment driving GDP. So, on the one hand, it seems like the kind of real economy, I guess you could say, one way of looking at it, and all the points you make about it leading to a recession and job losses and those types of things. But at the same time, you've got just so much, as you know, so much investment going on in building out the AI infrastructure. So how do you kind of square the risks here on the capital market side versus the kind of underlying economy side?
Well, I'm sympathetic to this concern about AI as the big bet. I mean, the most likely scenario is that it all plays out like other technologies. It takes time to diffuse. Technology doesn't diffuse until new companies form and optimize around that technology. Legacy companies like a Moody's, it's hard to adopt and just takes time, and it's enough time that allows the economy to adjust. We lose some jobs over here, but we gain jobs over there, and net we're fine. Yeah. That's the most likely scenario. But there's definitely a scenario, and it's certainly top of my list of concerns, that the productivity gains are just come on much faster than all that. And that we do start to lose jobs. And it is a big bet in another sense that if you look at the investment spending that's done in the economy, almost all of it is related to AI. If you look at the S&P 500 companies, over 90% of the capital spending done since ChatGPT was unveiled 3 years ago is in AI. The rest of the economy, the rest of the S&P 500, 5-10% of the capex. So we're starving the rest of the economy to provide the capital to drive AI. Yeah. AI better work. If it doesn't, right. Then we got a problem in the with productivity and growth on the rest of the economy. And I can feel this in companies. Companies are doing the same thing. They're saying, we got to go grab that bright, shiny thing. Well, if you do that, then you're not investing in kind of the business as usual productivity enhancing things that one would do, that are not for sure, but they're more sure than the AI bet. So yeah, I feel it in a macro sense. I feel it in a micro sense. We're making a bet. It better pay off.
Yeah. So I guess as we come up on our time, as you look ahead, are you tilting towards the pessimistic side for the next year, the optimistic side, or is it just a little bit too hard to tell given some of the volatility, particularly around what's going to play out with AI in the stock market in particular? The markets more broadly, I guess.
Steve, I don't know who said it. Maybe it was Warren Buffett, maybe Winston Churchill. I don't know. Maybe it was Mark Zandi, but it's like, don't bet against the American economy. At the end of the day, maybe 2026 ends up being a tougher year than anticipated, but, long run, we'll be just fine. We'll work through this. There's worse things in the world than having too much productivity growth, at the end of the day. So, we have to think about this and we have to worry about it. And we got to plan for it. We can't do what we did with globalization. We allowed globalization to run on, and on net, it was a massive plus for the American economy. We on net benefited, but it really creamed, a big chunk of the population. And as a result, we're struggling now with the backlash, politically, economically, everything else. So we got to really be careful about this. But at the end of the day, don't bet against the American economy.
Well, that's a good place perhaps to leave it. Mark, we're really grateful that you joined us on the Remarkable Retail Podcast. Been extremely generous with your time and your insights. If we wanted to point people other than just finding you on LinkedIn or Googling you, it'd be plenty to find. Anything else you wanted to point people to? Any studies or just other ways to follow your work?
Yeah, I do have my own podcast, Inside Economics, with two of my colleagues. We do that. You know what? I think we've done over 400 podcasts. So there, I got you.
Wow!
Congratulations. But that's one way of doing it. We also have a website. That's the
persistence you talk about, right?
Yeah, there you go. It's a therapeutic for me. I don't know about you guys, but I view it as it's like getting on the couch once a week. and just chatting with smart people, so that's good. But that'd be the best way. There's other ways you can pay, but I won't bore people with that.
But you'll take it. I mean, you're not.
I would take it. I would take.
You wouldn't turn
Moody's
it down.
would take it. I'm sure.
Yeah. We're the same way.
We're all capitalists. We're all capitalists here.
All right. Well, thanks so much again, Mark, for your time. We hope you have a great holiday and wonderful 2026. We'll all keep our fingers crossed that bubble will not burst.
I'm with you. Thank you.
All right, we are back. So, like I said, I hope we delivered on that promise. Very insightful. I came away this whole fingerprints of AI concept on youth unemployment. I thought that was particularly well stated, and just got me really thinking about the whole issue. Now, what are you thinking about? What's in your mind? What's on your mind for what you found particularly remarkable this week?
Well, this isn't a retail specific story, but when I read it, I was kind of like, So Meta, parent company of Facebook, as most would know, they announced, or there was a report, that they are going to be cutting their metaverse investment by 30%. And what was noteworthy to me or remarkable to me was, who's investing in the metaverse? That was like my big, and longtime listeners as well as retail observers will remember that if you were to go to a conference about 3 years ago, the topic was metaverse, which then shifted to retail media networks, now shifted to AI. But it does look like retail media networks and AI are a real thing, but the metaverse, not so much. So it looks like Meta is closing the barn door after the horse has been stolen already. So anyway, I just was like, wow. But they're still keeping 70%. So that makes me think they have not particularly given up on this. So maybe I'm missing something about the potential of the metaverse, but I feel like the world has moved on. But now, I guess when your name, when your company is Meta and the program is Metaverse, perhaps it's a little harder to let go of that.
On my side, it's kind of a curious thing. Sleep Country Canada, which is a very successful bedding retailer here, they just bought the IP for Bed Bath & Beyond. So they plan to relaunch, and they made this statement. They said Bed Bath & Beyond holds a special place in the hearts of homes of Canadians. And, this is a new chance to write a new chapter. Okay, thoughts and prayers to that, but it does get me thinking about can brands come back? You and I have talked about that over and over again. Toys R Us made a run for it in Canada. That's pretty much collapsed to zero now. That has not been successful. So anyway, I just thought it was kind of like, are you expecting to take those customers out of the hands from TJX and HomeSense and Marshalls and Canadian Tire and IKEA and Walmart?
A lot of competition.
Blah, blah. Right. Anyway, so I thought that was just kind of interesting, and it just gets me thinking all the time about old dead brands. Do they ever die? Can you bring them back? Let's talk about what's on your radar screen for the weeks ahead.
Well, I have two hopefully quick things. One is, and this kind of ties back to what we were talking about at the top in this period right before Christmas wraps up, is what I know a lot of people call retail's holiday game of chicken. Consumers knowing that oftentimes there are great deals to be had as you get closer to the holidays because retailers panic, right? I just wanted to give a quick sample of one here with my daughter, Elena, who was with me over Thanksgiving, as was my other daughter, Claire. But Elena had gone shopping at Ann Taylor Loft and saw some things. And then she was online looking at the website while we were watching football or something. And she kept telling me about the emails she was getting for Loft. So in about a 1 hour time frame, she got 3 emails from Loft. One was whole store 50% off. Then the next one was take an extra 20% off on everything at the store. Then the next one was like free shipping plus 20% off plus 50% off. And then it was free shipping on, and there was a minimum order value, free shipping on $35 or more, or whatever it was. And then it was like free shipping on anything. It's like, when are they coming to our house to like please buy from us?
What that reminds? It reminds me, Steve. You remember you and I used to probably hope read the National Lampoon magazine and their famous cover with a famous cover, which actually turned out to be very political these days, which was subscriber will shoot this puppy.
There's put Christy Nome now on the cover. Yeah. So anyway, I just think it's the way retail has been for a while, and it's just interesting to see how this will develop over the days and I guess a couple of weeks ahead. The other one I wanted to mention, which is interesting, I think for a bunch of reasons. So the Netflix house, which is this, I think we mentioned this a year or so ago when Netflix said they were going to open this experiential, quote unquote, experiential retail concept? Well, the first one did open at the King of Prussia Mall outside of Philadelphia just a few weeks ago. The second one is opening just about 10 minutes, 15 minutes from me in the Galleria Mall in Dallas. So I'm eager to take a look at that. My understanding is it's got some food offering, and they've experimented with parts of this. I know they have a cafe in Las Vegas, and they've done some pop-ups, but they will have a series of things based upon their shows. There's a Stranger Things. I don't know exactly what it is, Netflix merch. So I'll be really interested to see that. The other thing that I think is interesting about this, which is bigger than just for people that happen to be in the Philadelphia or Dallas area, is will this be something that Netflix can scale? Part of the reason why I find this interesting is in both cases, they've taken space that was previously a department store anchor. I know as you think about the reconfiguration of some of these malls and spaces that have been vacated by Sears and Pennies and others over the years, what do you do with that space? Well, maybe Netflix houses something. So very early, obviously, they have not said anything about their plans to expand this beyond a handful of stores. But fun thing to see, convergence of media and merch.
Well, I guess the landlords are moving on from putting in pickleball courts into the old department store space as well. From my perspective, congrats, speaking of which, to Chris Schultz. He was a guest on the show when he was running Voodoo Donuts, and now he's taking over Velvet Taco. He's moving to your neck of the woods. As I said, prior guest on the show, very interesting brand. And speaking of taco, you like what I did there? We're recording this on the Friday, World Cup draw day. And both Prime Minister Carney and Mexican leader Sheinbaum are together with Donald Trump. And maybe there'll be some pull-asides there around tariffs and around policy. So I'm looking to see what comes out of, the draw. Does Canada wind up in the group of death? And what happens from some pull-asides over the World Cup trophy. All right. Well, that's the show. We will be back next week for our final week, actually. We're going to do 2 episodes. We're going to do Steve's traditional kind of review of the predictions episodes. So we're going to do our standard episode with the news of the week and all the great content. And then we're going to do and release a bonus episode. So much content to pack into one episode. We're going to break it up into 2 episodes on the Tuesday and then the Friday. That will be it for the calendar year. And we will be coming storming back with 2026 and season 12, amazingly. So stay tuned.
Thanks for tuning in. To help more retail leaders discover the industry's leading podcast, please drop us that 5-star rating and review on Apple, Spotify, YouTube, or wherever you enjoy your pods. And for more on my strategic advisory services, keynote speaking, best-selling books, and even more retail industry insights, go to StephenPDennis.com.
If you are a brand or service provider looking to take your influence to the next level, reach out to us for sponsorship, advertising, or event partnerships. And if you want to learn more about my own keynote speaking and advisory practice, reach out to me via LinkedIn.